Hey, Dan Passarelli here. I was DMing with someone in the MTM community chat room in Slack, and he was asking about something that I know a little bit about because I used to do it for a living, and that was how market makers hedge. And it's a fairly simple process with a little bit of nuance, but I'm going to give you sort of the high level here and an important takeaway. So let's say that a market maker buys calls, right? Which means basically that there's someone somewhere in the world who wanted to sell those calls to the market maker and sold them on the market maker's bid. So the market maker looks down at his or her computer and says, oh, well, I just bought calls. Now what do I do? Well, think about it. What does the market maker have as far as a risk situation goes? Well, the biggest risk with any option trade is delta, right? That market maker who's now long calls, let's say bought 10 of these Amazon August 16 180 calls. If the market maker bought 10 of those, well, he has a bullish position. But the market maker's not bullish. Somebody just hit the market maker's bid. The market maker wasn't looking at a chart and decided to take a bullish position. The market maker wants to get rid of that bullish position. So what he or she does is sells shares of stock short on a one-to-one basis with the delta. So let's see. If someone came in and sold the market maker 10 of these 180 calls, the delta here is 42. So 10 times 42 is 420 shares worth. So that market maker, once he looks down at the machine and says, oh, I bought 10 of these, is going to turn around and sell 420 shares short to offset the directional risk. Now, in reality, probably the market maker would round to 400 instead of selling exactly 420. And 10 lots are pretty small trades when it comes to market makers as well. They do definitely trade a lot of those, but they end up acquiring really, really big position and sometimes hedging with many hundreds, thousands, sometimes many thousands of shares. So that's how we do it. Buy calls, sell short stock. Buy puts, buy stock, right? Because if I'm buying a put that's a short position, I need to offset that short position by a long position, buying shares of stock on a one-to-one delta basis. I sell calls, I buy stock, sell puts, sell stock. So that's how it works. Now, a key takeaway from that is when this does trade in bigger positions, not 10 lots, but 10,000 contracts, like Goldman or Morgan Stanley comes in, and they're the ones who are buying these puts or buying these calls or whatever. Well, guess what? If the market maker has to go in and buy 10,000 shares to hedge that option position, well, that creates upward pressure on that stock. So it is a fact that the options market does indeed influence the supply and demand factor for the underlying shares of stock. Something to think about, something that will help you understand options better and therefore trade better. This is Dan Passarelli. Continue to trade smart.